Alright, what's going on, guys? It's David from the SPX program. Today we are going to go through an Iron Condor tutorial. The first thing we are going to do is we're going to do the easy route first, and then we'll get into some more complex, which includes, the bid-ask price and what the calls and puts mean. So, the easy part. A Iron Condor is comprised of 4 legs. So, this is the market. So this is SPX, and you have the time, and then you also have the price. So this is typically, a chart that you might see go like this or whatever. Could go up or down. So what is an Iron Condor? So an Iron Condor is comprised of 4 legs. The first thing you have is a short call. It doesn't matter which one you do first. And then you have the short put, and then long put. For this, we'll do plus, minus, minus, plus. So, how do you achieve a max profit from an Iron Condor? You make money from Iron Condor when SPX, the closing price, stays within these short strikes. So you have to call, you have to short put, the long put. As long as the market closed within this area. And so we'll add in the numbers now. So let's just use a placeholder, okay? So let's say SPX was starting at around $100. The short call could be, let's use $150. The long call could be 155. So 150, 155. The difference between that is $5. $5 is the width of the spread. And so for the short put, we'll just use we'll use a number, placeholder, 50, and then the long put might be 45. Equally $5 in spread. So you achieve max profit. When the closing price is between these two, short puts and short calls. It's kind of like a ping pong game or tennis. The ball has to stay within this range. So how do you get a max loss? A max loss is when the SPX closes above this range, above your long call, or it closes below this side, the long put. That's how you get max loss. So let's add in a bit more complexity now. So when you sell a short call and a long call, this is called a call vertical. When you sell a short put and you buy a long put, this is called a vertical put. When you combine them together, it's called an Iron Condor. So when you're selling an Iron Condor, that's a $5 spread. You can sell it from anywhere between this price. On average, we'll collect $2 worth of premium. We'll use that as a placeholder. It's an even number. And how do you get $2? And why is it 2.00? Options are multiplied by 100. So if it says 2.00, you move over to decimals like this, and that's how you get $200 conversion. If you were to just look at the call side, and you were to construct the call side only first, you might achieve $1 in premium. If you open up the put side, it will also be, I don't have any space to write, but it will also be 1.00. Combined together would make 2.00. So how do you get 0.00? 0.00 means it's at max profit. So over time, by the end of the day, the options for the calls and the options for the put will expire worthless as long as SPX stays within this range. And the max loss again is 5.00. That's the furthest it can go. So how do you calculate what the break even, the max profit, and max loss is? So the max profit equals premium that you collect. So in this example, 2.00, we'll do the conversion, $200. The max loss equals the width of the spread, which is $5. It's a $5 spread, and it's $5 because the call side is 150 and then 155. That's $5 difference. Same here for the short side, 50 and 45. That's $5 difference. The max loss calculation is $5 minus the premium that you collect. I can also put 2, or it doesn't have to be 2, but it could be 5 minus 2 equals $300 in max loss. Now the more complicated part is what happens when SPX closes. For example, if it closes at $151. So if SPX closes right here at $151, it's $1 above the short call. Okay, so how do you calculate the break even? So the break even calculation is, you're collecting $2 in premium, okay? And your short call above is $150. So we'll do the break even for the call side and the put side. The break even for the call side is $150 plus the $2 worth of premium. So your cost basis is $152. And for the put side, your short put is 50, and your cost basis is going to be 50 minus 2. One thing you should notice is that your break even is always moving, away from your short call into your long call, and then same thing for the puts, it's moving away from the chart. So the break even is always, you take the premium and you add it this way, and for the put side, you take the premium and you add it this way. That's how you get 152 for the top part and then 48 for the bottom part. So if SPX closed at 151 and your break even is 152, that's your cost basis right here. Cost B. Let's leave it as that. Cost basis 152. We know that as long as it's under 150, which is here around this area, you'll achieve a max profit of 2.00. But because it went up a little bit above the short call to 151, you now have partial profit. So if your cost basis was 152 and it landed at 151, it means that you made a profit. You made a profit of $100. So your profit here, this is a partial profit, okay, of $1 because it's $1 below your cost basis. So $1 converts over is $100. Well, what about partial loss? Partial loss happens when it closes above your cost basis. So for example, if the close was 153, so if it closed at 153, then and your cost basis was 152, it's $1 above. So your partial loss is negative 100. And of course, when it goes outside the long call, which is 155, that's your max loss. And we already know what our max loss is here. Same thing for the put side. All you have to do is just reverse the cost basis. So 48 is the cost basis here on the put side. So if it closes at 49, then you'll have $1 in profit, which is 100. If it closes at 47, then you'll have a negative $100 partial loss. And of course, if it closes below all the way below the long put, then that's how you get max loss. Now, let's talk a bit about how the premium is affected by the SPX. So we know that this is the SPX. And this is the chart, right? You have your call side and you have your put side. You collect maybe a 1.00 premium here, you have collect a 1.00 here. In total, you get 2.00. And that's your max profit if you close inside. So, for example, if SPX trades closer to the call side, this 1.00 might drop down to 0.50, right? And remember, When you get to 0, it's your max profit. When you get to 5.00, that's your max loss. Okay, so this is your max loss, and this is your max profit. So this is just an example of how the premium moves. So if the SPX continues up during the intraday, this put will lose value, which is a good thing. It's profitable for the put side. But remember, since it's moving towards the call might be a bit more expensive. So it might go to maybe 1.50. And so that kind of equals out. So one thing with the Iron Condor is that in order to get to 0, there is time decay. It's otherwise known as theta. There's a calculation for this on options, but there's also implied volatility. So as implied volatility goes down, the spread price might go down too. But we don't really have to focus on this. We should just focus mostly on where the SPX price closes. So if it goes up here during the intraday, this put could come back down to maybe for example, it could get very close to max profit, but obviously this can't get to 0 until it expires. And this call could be like very close to max loss. It could be 4.90 or whatever, right? But as long as SPX comes back down between the ranges, then you'll achieve max profit. But remember, if it moves away from the put, you'll have more profit on the put side. So sometimes we might close just the put side in case it comes back down. If it comes back down, then the call side will lose value, right? And so for Iron Condors, the goal here is we want SPX to close right here. This is where we get 2.00. And when we get the full profit, which is $2.00, $200 worth of premium at 4 p.m. Eastern time, right? So during the day, the market opens up at 9:30 a.m. The premium could start at 2 over here, and then once it gets to expiration on this side, the time difference will make it 0.00. Make sense? During the day, if SPX is within the middle price, that the premium could fluctuate. So it could drop from 2 to 1 right here at midday, and then eventually this price could increase or decrease depending on if it gets closer to this side or if it gets closer to this side, right? But at the end of the day, it should hit 0.00 as long as SPX closes in the range, right? So that's the easy and complicated part. So again, there's two things that can happen. Number one, you make money, or number two, you lose money. And the next thing is that there is a calculation for everything. There's a risk and there's a calculated risk and reward. You know you're gonna make $200 or you lose $300, right? It's either 200 or you lose 300. It's a binary thing. It's either this or this. And you either make 200 if it closes inside, or you lose 300 if it closes outside of these ranges. So the next thing is a bit more terminology. What do calls and puts actually mean? So to first start, we'll talk about the put side, and we'll use an analogy. So for the put side, the analogy here could be like a house, right? You got a house here, cool little house. You got 2 windows, whatever. And then with houses, you have to buy insurance, and you buy it from this guy over here. This guy he's the underwriter, and he sells you a policy. This is the insurance policy. You might pay $4K a year. I don't know what the current rate is going right now, but you have a house and you want to buy insurance in case in case the house burns down or whatever. You're buying this contract to protect your house, right? And this contract, although it's not a one-to-one correlation to puts, is very similar to puts, because when you buy puts in the stock market, you might have assets too. So you might have like Apple or Tesla or Nvidia, or you could just have like SPY or whatever stock you have, right? Because whatever stock you have, it's just an asset. So if you buy the stock or you buy the index and you buy it at $100 and that's your cost basis, you might want to buy a put. If you think the market's going to crash or something like that, you buy a put. So you have a put contract. And of course, there are buyers and sellers of puts and calls. So if you're buying it from somebody or from the market makers. So if your cost basis is $100 and you buy an insurance contract, which is the put, at $90, at $90, you might pay, a certain amount of premium for it. It could be like five or whatever it is, and 5.00 equates to, of course, $500. So if the stock price goes down all the way to zero, hopefully it doesn't, but let's say it goes down to zero, well, you have the put contract, you have insurance. You can exercise that insurance. And instead of losing everything and having $0.00 in your bank account, now you exercise that put contract and you are able to sell it at 90.00. It's kind of like a stop loss, right? And so that kind of correlates here with the Iron Condors. This long put is your protection, right? Because if the stock market keeps going down and down and down, you have that long put as protection. Because what the short put means is that the terminology for short put means that you are obligated to buy at a certain price. And for the short call, it means that you're obligated to sell at a specific price. Now, for the long put, you have the right? So you have the right to exercise. You aren't obligated. Same thing with the call. You have the right to exercise, but you're not obligated to. So, as long as you have the protection here, and you have the protection here, the short put is what actually makes money when the stock price goes up, and the short call is actually what makes money when the stock price goes down. So when the stock price goes down, the short put the short call will earn money, and the long call will lose money, right? But when you combine it, as long as it goes down, the vertical spread will make money, right? It just kind of offsets itself, and that's why there's a protection here with the long call and the short call. That's why we have a $5 spread here, right? The $5 difference here, that's your $5. That's the maximum you can lose. That's how you get the break evens here. The max loss, sorry. That's how you get the max loss, is the $5 spread minus the premium that you got, which is 2.00. That's your max loss. Pretty straightforward. Now, if you also wanted to know what the call side is, and of course the put side, there's buyers and there's sellers, right? So the seller is the underwriter for the policy. The buyer is you're trying to insure assets. Now, one thing with options is that options are typically priced to work against the buyer, right? That's why insurance companies make money, right? They're in business. They're a big company, right? Most of the time they make money on selling contracts. So for the call side, the terminology for the call side is you have the right to exercise. So let's say we'll use like egg prices. Maybe we shouldn't use eggs because I don't know how to draw eggs cards. So we'll just do eggs here. So let's say the egg prices are a carton of eggs is like $2, okay? And all of a sudden there's a big news event that there's bird flu. So what do? Well, if the prices right now are $2, you want to have the right to lock in that price, right? So instead of buying a quadrillion cartons of eggs that might go bad eventually, instead you buy a call option. So one call option equals 100 shares. And one thing I should have mentioned is that for contracts, each contract is 100 shares, right? So puts is 100 shares, calls is 100 shares. So if you're buying one call of any of these stock, it's 100 shares increments. So you have 100 shares or 100 egg cartons. And you pay maybe $1 for it, right? Let's just say, let's do like $5, something like that. And so your cost basis is now is the 2 plus the call option, right? Plus the call option is $5. So now your cost basis is $7. Well, this might seem expensive, right? Your cost basis might be kind of high. But what if, the egg prices are now, draw eggs here, maybe like a year later, the egg prices might be $24. So instead of buying $24 for a carton of eggs, you exercise your call option, and then now you could buy it at $2 plus the premium that you paid, which is $7, right? And so that's in a nutshell how calls work. And of course, like always, you are a buyer, but there are also sellers here. So whoever sold you the contract, they collected $5 premium from you. And so if egg prices do not exceed your cost basis, then you'll lose money on that contract. And if it goes above, then the sellers will probably lose money on that, right? Because they could have just not sell the premium and just sold the eggs for more, basically. So again, puts and calls, both buyers and both sellers, because that's what makes the market. So next thing is this is a bonus, is implied volatility, otherwise known as VIX. So a part of how options pricing works is through volatility, implied volatility, meaning that if, for example, there is a bird flu or whatever, there's a big major event, COVID, whatever it is, these call contracts or call options will increase in premium, right? And there might be a lot more people buying these calls because they know there's an egg shortage, right? And so the market's an efficient place. Efficient meaning that the markets will price in to make sure that you're not getting a huge edge on that, right? And so that's kind of what implied volatility is. I won't go too much into detail, but I think what's important here is that the more volume and more contracts traded, the higher the call options, the higher the put options, and that also affects our Iron Condor. Implied volatility affects Iron Condors if the volatility goes up, and volatility it's a chart you can see too. It's you can look at implied volatility. You can look at volatility. It can go up, right? And if that goes up, the ranges for the Iron Condors can go up. So, for example, this is currently 150 on the short column. We'll just talk about the short strikes. So, if the implied volatility increases, you might be able to sell, a $200 short call and maybe like a $20 short call. It's just a wider spread, right? That's the example. You can get a wider spread and still get $2 worth of premium because the market's pricing in the volatility, and the market does a really good job with pricing that in. All right, so one more bonus material I wanted to include. So I also wanted to include this. This is also important. There is credit and debit. When we trade short Iron Condors, this right here is a short Iron Condor. Okay, the short is a credit, and then the long Iron Condor is a debit. So credits typically, when you're collecting that 2.00 premium, typically it's negative. You're receiving a credit, and you will have to buy back at 0.0. Technically, you don't have to buy it back because it expires. Or if you collected $2 in premium and you decided you wanted to close the trade early, if you close it for 3, for example, you have to pay a debit to close this out, and that would be your loss, 3 minus 2, right? And so what's important here between credit and debit is that credit, you make money from a short Iron Condor when SPX closes within this range. But if you flip the order to debit, so you're paying a debit instead, you make money when SPX closes outside of the ranges, right? So like I said, with the markets, there's two sides. Whenever you are executing your trades, you always want to stay debit. One of the biggest mistakes people make is that when they fill in their orders and they get, a credit, they might switch their quantities from like negative one contract, and they might accidentally flip to +1, and that might change it to a debit. Okay, so one more thing here is that this short call here, this right here, the short call, this is a bearish strategy. It makes money when the markets stay below it or down. The short put, it's a bullish. So one's called bullish, one's called bearish. Bearish is down. Bullish is up. So that's why you make money when SPX closes within this range. You make money from the call side when SPX closes below the short call. You make money from the put side when SPX closes above the short put. Got it? And so knowing that this is bearish, what is bullish? Bullish is if you had a long call, and of course this is the SPX here, and of course it can go whatever, and you flip it short. Now if you had a long call and then a short call on top, this would produce a debit, right? It just flip flops, kind of mirrors around. Same thing with the short put. If you flip it around and you do long put, and then you have the short put, this would create a debit. So you might pay, it doesn't have to be one, but it does flip, right? So now you make money if it goes outside, or you make money if it goes outside this range. But for the SPX program, we typically stick with the short Iron Condors. If you're a bit more advanced and you join Infolytics, there is the long debit, and you can make money from both sides. Cool, you get another bonus. One more thing I thought about. Okay, so closing orders. So you have the 155 long call, and you have the 150 short call. To close this out, you would need to do the opposite, right? So the opposite here is you would have to buy. You have to buy the 150. And opposite here is you sell the 155s. That's the opposite. That's the opposite of the closing order. Same thing over here. I'm not going to write it over, but it's the same thing. So for example, to close it out, you would just do the long put and then short put. And that's the opposite here. One more thing is the synthetics, right? There's one more thing, and this is my final sheet of paper. So synthetics. So let's say you have the long call. So you have the short call and the long call. And this is a bear strategy. To do the reverse, you need a bullish strategy to offset to cancel it. So what you could do is you could do a short put and a long put, because this one is bearish, right? You make money when it goes down. And in order to close it, either you just close the spread and your positions will zero out to zero, or in some circumstances, you could do a synthetic, which means it's you add in a bullish strategy. So you do the short put at 155, and then you do the long put at 150. This is really unnecessary, right? You don't have to do it, but the point is to show that you can kind of move around the puts and calls to make it, a synthetic trade. The only benefit for this is avoiding, it's a loophole for pattern day traders, right? Because when you open a trade the same day and then you close the trade the same day, that counts as one day trade. But in the SPX program, we open our trades a day prior. So if we close it the next day, it does not count as a day trade. However, in some circumstances, there are some people that might have missed a trade or whatever, and they try to open up the next day. Well, if you open up the next day and you close the same trade, that will count as one day trade. you get 3 round-trip day trades per 5 business days. If your account falls under 25K, your account could get locked for 90 days, and you don't want to do that. So if you open up the trade the same day, instead of closing this out with a long call, a short call, you can do a synthetic instead. So for example, you would do if if the long call was it's if the long call is worth $2 in premium, the debit you would pay is 3.00, and that kind of cancels each other out. That's how you do a synthetic. And the purpose for it again is to just it's a loophole to not trigger pattern day trades. Sounds good? I'll see you guys on Inside.